Hello, I'm Jeff Thompson, President and CEO of IMA, the Institute of Management Accountants, and welcome to Unit 4, Risk Assessment of our course, Improving Confidence in Sustainability Information. So in the last unit, we talked about the control environment, and in this unit, we're going to talk about risk assessment. So in this Unit 4, Risk Assessment, we're going to define the principles associated with the risk assessment component of the COSO Internal Controls Framework Cube. We're going to relate aspects of these principles to actual practice, and then we're going to define and discuss what's known as the fraud triangle. So, Principle 6, absolutely critical to internal controls, to business performance, both sustainability information and non-sustainability information. Principle 6 of the framework states the organization specifies suitable objectives with sufficient clarity to enable the identification and assessment of risks relative to objectives. This is where it all starts. You will have a stronger risk management profile and a stronger system of internal controls the more you're able to specify objectives that are specific, measurable, actionable, realistic, and time-bound, also known, of course, as SMART objectives. The more you can do that with clarity as a business in your strategic planning, whether these objectives be financial objectives or societal objectives, sustainability objectives, clarity of objectives is critical to both risk management and internal controls. So, it's very important to consider statutory requirements. So what is required or expected or even useful for external reporting, best practices, and what is really needed for both internal and external use. What does the organization, the board of directors, and others need to know about the material risks facing the enterprise in its pursuit of business objectives? Of course, there's going to be different types of metrics and different precision levels. As we've alluded to before, financial measures tend to be more precise, they tend to be shorter term, they tend to be more quantitative. Sustainability measures, on the other hand, like social capital, human capital, innovation, tend to be more qualitative, longer term, and require more professional judgment in estimation and assessment. Identify leading indicators. In many ways, sustainability information, innovation, new products put in the market, new talent that you've hired, new companies that you've acquired, these are often leading indicators for financial performance. So the two relate very, very much. And then finally, as it relates to disclosure for sustainability information, avoid boilerplate and vague type of language in disclosures. And let me just describe this very quickly. Boilerplate information to investors in the management discussion and analysis or in the annual report basically is broad brush language. That sounds good, but it really doesn't offer investors or others a whole lot of insight in terms of what the organization's doing. It could say that we strive to improve and lessen our carbon footprint or consumption of natural resources, or we strive to hire the most competent individuals. Helpful, nice to know, but not very actionable, not very quantitative. So one of the things that SASB has done, SASB, of course, from Unit 1, is the Sustainability Accounting Standards Board in the US, a non-for-profit organization. What they've done is they've defined material measures for each of 79 industries that are more quantitative and more comparable across industry. So that now when an investor or another stakeholder sees a disclosure about sustainability information, they can compare it to other companies within that industry vertical, and they have some sense as to what is the growth, what's the deterioration in the performance, versus broad brush qualitative type information. So let's take a closer look at CalSTRS, which is the California State Teachers Retirement System. It is the 11th largest public pension fund, the 11th largest public pension fund of, as of 2016, about $200 billion in assets. And I'd like to read you this quote from CalSTRS that I think relates to the risk assessment component. They said the following: by considering the required level of precision for reporting material sustainability information to external users and complying with an externally established standard for disclosure, CalSTRS is better equipped to more effectively and efficiently meet its sustainability reporting objectives and deliver decision-useful information to investors interested in the long-term financial viability of the fund. And this is a quote from Robin Matson, their CFO. So just think about that quote, as long as it may have been. They're talking about how they're using sustainability information and assessing the risk around sustainability information to help inform investors as to the long-term viability of the firm. So the disclosures that they refer to that are more decision useful for investors versus broad boilerplate, fluffy type of language is from the SASB disclosures process. As I said earlier, SASB worked with various working groups of investors and corporations. They defined material measures for 79 industry verticals, and those are the measures that are deemed to be material and decision useful. And so CalSTRS was a first mover on this, and they're to be applauded for getting into this game early, because it's what investors are looking for, and it's what society is looking for to understand the well-rounded, balanced performance of the organization. They also make use of internal processes. They leverage internal processes to assure sustainability information. And that's a very key aspect here. The role of the CFO team and other teams who already assure financial information, is it possible to leverage that resource to better assure non-financial sustainability information in a cohesive and integrated way? The answer is yes. Principle 7 within the risk assessment component, the organization identifies risks to the achievement of objectives across the entity and analyzes risks as a basis for determining how the risk should be managed. So Principle 6 was all about clarity of objectives, both financial objectives and sustainability objectives in this sort of balanced approach to business performance and value. Principle 7 is about the process to identify the risks relative to achieving those strategic objectives. And we haven't even talked yet in detail about control activities, which we will in the next unit. So, identifying and evaluating risks is an ongoing process. Risk management is very tricky. You can get the smartest guys in the room, smartest gals in the room, and think that you understand all of the material risks that could be impacting performance. But business often isn't that simple. You may have very smart men and women in your company, but understanding all types of current and emerging risks might require bringing in external experts, or at least looking at third-party sources. These are competitive risks. These are talent management risks. These are digital transformation risks. All of the risks that could impede or impact performance are the risks that you need to develop. When I think about ERM, or enterprise risk management, the real R word in this whole equation of sustainability information, risk, and controls is reputation. Nothing less than the reputation of the firm is on the line if you don't provide investors with the sustainability information that they're seeking, if you don't manage risks, if you manage the risk but you have a poor system of internal controls. All of this cascades and results in a damaged reputation, and nothing should be more important to an organization than its reputation and its brand. So this risk assessment process is absolutely critical. When you think about organizations like Wells Fargo has a very inspiring commercial established 100 years ago, reestablished in 2018. Think about their risk assessment process and internal controls and how it failed them in the challenges they had with sales compensation. Very, very important to assess all entity risks, both financial and non-financial. So now we come to Principle 8. Principle 8 of risk assessment within the COSO framework talks specifically about fraud. And when you think about the many, many frauds that have been committed, and frauds are happening today as we speak, there are three pressures or three issues that comprise what are known as the fraud triangle. And this is the first one that I alluded to, is pressure, peer pressure, the pressure for short-term earnings. You know, in Unit 1, when I was defining the call to action here, I referenced some headlines and some quotes from Jamie Dimon, CEO of JP Morgan Chase, and Warren Buffett, who talked about how important it is to move away from short-term earnings guidance, because we have this intense pressure to produce the guidance that we reported to Wall Street or to our regulators. And this pressure creates undue behaviors, or behaviors that perhaps are not in the best interest of the corporation. So it's important to understand the drivers of fraud so we can mitigate the risk of fraud. Maybe move to more long-term measures, more of a balanced scorecard, offsetting controls, things of that nature. Another element of the fraud triangle is opportunity. We even see this at the local level, at city clerks, town clerks, who say, boy, I'm in charge of all this money. It's so easy for me to just skim a little bit. I'll just skim a penny off each transaction. Nobody will notice. I have the opportunity. I have the access. Of course, one way to mitigate this sort of opportunistic approach to fraud is segregation of duties, or make sure there's checks and balances throughout the ecosystem. And then rationalization. Well, I'll just do it this one time. It's not going to hurt anybody. Nobody's going to notice. But again, if there's a system of check and balances, if you go back to Unit 2, the control environment, the tone at the top, what matters to people, what matters philosophically to the organization, doing the right thing, these could all be deterrents to the opportunistic and rationalization elements of fraud. So I referred to segregation of duties as a very important element of internal controls for sustainability information and for financial information. And notice that we're taking the COSO components and principles and applying them to sustainability information, just as we apply them normally in a mature way to financial information. The difference might be materiality and the level of assurance that you can expect. Encourage a strong culture of open communication. There has to be open communication and honest communication that protect whistleblowers. You know, in the early stages of Sarbanes-Oxley legislation in the United States back in the turn of the century, 2002, 2003, there was a whistleblower provision, but it didn't do a very good job, quite frankly, at protecting those who were telling the truth. That's very, very important. And then performing regular assessments, periodic and in-process assessments of fraud risk relating to sustainability. You know, if we're reliant on natural resources to conduct our business, and there's a natural disaster, we better understand that. We better understand hurricane projections, for example, if we're in countries or states where hurricanes are a factor. What if there's trade wars and trade issues going on that could impact our business and our consumption and our value generation? All of these risks are very, very important to understand. Now, this relates to fraud risk, of course, stealing of assets, stealing of resources, et cetera, et cetera. Very, very important to keep on regular risk assessment. Principle 9 of risk assessment is identifying changes that could impact your risk profile and therefore your control activities that we'll talk about in Unit 5. The organization considers, identifies, and assesses changes that could significantly impact the system of internal control. Now, I don't know about your environment, but the environment in which I live and work doesn't change at all. It's perfectly still. My risks, my objectives stay the same, right? So now you know that I'm kidding. Change is inevitable. Change is massive. You know, it used to be that the change that we reflected in our environment was known change, competitive risk, risk of obsolescence, environmental risk. Today, the risk is unforeseen. The pace of automation, robotics process automation, cognitive computing, artificial intelligence is far greater, far faster than we could expect as consumers and professionals. Are we updating and keeping our risk current? Do we need as many employees to do the routine, repetitive tasks that we needed before? Do we need to upskill our employees to take on the higher tasks requiring human judgment and analytics and professional skepticism? All of these things are why we have to keep our risk profile current and ahead of change to the extent possible. So the business model is very important. You know, all the various environmental risks and environmental changes need to be assessed periodically for change and how they impact our system of risk profiling and internal controls. Political, legal, regulatory, cultural, technology is so key given the pace of change. So we're going to take a look at Sky Racing World, which is a Australian-based gaming company. It's a smaller firm. One of the key points about COSO internal controls as it relates to financial and non-financial information is COSO applies to organization anywhere, any size, any structure. Could be a small organization, large organization, and that's why COSO is principles-based, because we want it to be scalable to fit the norms, philosophies, values, and ethics of any size organization. So as I mentioned earlier, Sky Racing World is a smaller Australian-based gaming company providing racing broadcasts and racing data to wagering outlets in the Americas and the Caribbean. Their earnings are calculated from complex software they develop to track wagers, currency evaluation, etc., that they capture in what are called TRA files. I actually asked the folks at Sky Racing World what TRA stands for, and they don't actually know. It's probably one of those institutional terms that everybody knows. It's a TRA file. But what they did was they produced custom software that resulted in very, very tight internal controls that helps mitigate the risks that they see in the wagering process. They capture non-financial data in these files as a result of very, very tight controls. And this helps to mitigate the risk of error, of a wagering error, a transaction processing error. And very, very important, and this relates back to Unit 2, the control environment. Leadership creates a culture where everyone feels accountable for their part of the internal control ecosystem, whether it's financial data or non-financial data. They also have external audits and other levels of assurance to increase confidence in this type of sustainability information. And confident controls allowing the right people to have the right information at the right time. So that concludes Unit 4, Risk Assessment. Thank you very much.